Good afternoon, everybody. We're joined by Mark Fisher, who's an influential member of the futures industry, a globally respected professional trader, a guest speaker at industry conferences, and the best-selling author of The Logical Trader, Applying Methods to the Madness. How's it going, Mark?
Good, Mike. How are you?
I'm good. TGIF. As I just introduced you, I was mentioning The Logical Trader, the book that you wrote about a decade ago. A lot of people have really read it and respect it and really got a lot of great information about it. And so I was hoping you could kind of tell us a little bit about the ACD method that you talk about in the book.
Um, when I was working on the floor before I graduated from college, I kept noticing back then when silver was probably the most volatile thing on the planet, that the opening range in silver tended to be the high or low, like 10% of every day. And if you just go by the random walk theory, there's no way that the open or any price should be the absolute low 10% of the day or the absolute high. And what I mean by that is that the market never even traded back to that price, to that print ever again during the day. So that got me thinking that actually the opening auction has that has a value to it unto itself, and has and refutes random walk. And so I did this thesis paper on a simplistic ACD model, which is basically a breakout of that opening range, where if the market moved enough out of that range in a certain period of time, you got long or vice versa short, and then you close out the trade there in the day. The problem with ACD, not the problem, but the challenge with ACD is that you need a market that's volatile, because if it's a market that just sits, obviously you're going to lose money. But you need a market now that's that actually has follow through during the day and has intraday movement. Just because the market gaps higher or lower doesn't mean anything if the market doesn't move intraday, because this is just a day trading system. And then eventually we took ACD and made it into a longer term system, but that's for another conversation. But how it's been refined over the past 20 years is not only just use ACD straight, which is too simplistic for the markets, but we use it in combination with price versus time, that we use ACD, not just opening ranges, but other time periods during the day, where if the market's above or below for a period of time, we buy X or sell X, and we keep doing it, and then look to close it out at the end of the day or hold it for the next day.
So touching on that point, what other times of the day now are you focused on that maybe you weren't focused on like originally, when you developed this?
Well, it depends. Usually we look about an hour, and in commodities about an hour and a half before the close, and for equities about 2.5 hours before the close. Why that works, I can't really get into that, but that's what works best for us. And then we also look at 4 o'clock in the morning when the London market, 3 o'clock to 4 o'clock in the morning when London opens, when the European markets open.
So those are the kind of ranges, the time ranges that you capture that you still kind of look at as very influential times throughout the day.
Not influential. It's like a marker. Like why should Europe? Why should the opening time in Europe at 3 o'clock in the morning be the high or low in crude oil until 10 o'clock in the morning? It doesn't make sense, but it seems to happen much more than it should.
Right. And so it's just observing those are the key times that you find are the most important for future direction, things of that nature to take signals off of.
Right. Exactly.
So then take me back though in, the late 70s, early 80s when you developed ACD. This is before Microsoft Excel. This is before all that sort of stuff. How did you kind of plot all this information and then backtest it?
Well, backtesting was a challenge, but really back then I was able to go ahead and exchange information, do it by hand. Obviously, there was a lot of missed data back then, and the data is a lot cleaner than now. And then we just walk forward and traded in a walk forward model and see and basically, to be honest with you, when I was 18, 20, we just winged a lot of it. But the concept worked, and in fact, there's been a lot of papers written on opening range breakouts by a lot of big modeling firms over the past 15, 20 years. They all do it a little differently than we do, but the concept of an opening range breakout in volatile markets definitely works. The challenge is to identify, is the market volatile or is the market just chopping around? Because obviously in a choppy market you're going to get chopped to death if you're trading any type of breakout system. So there's two challenges. One, to identify whether the market is, moving intraday, and two, to determine whether or not, what the variables are to capitalize on that movement. So, because if you just trade straight, breakouts every day in every market, in the market, let's take natural gas, for instance, which, a lot of days doesn't even move, you know, that, 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 trading a breakout of natural gas would be a huge loser, you know,
Right.
also. So, it's a lot more complex now. The model that we use is a lot more complex now than what we used to use.
Yeah, absolutely. And then I'm assuming analyzing it on a lot of different markets, and like you said, there's certain markets that it's probably more opportune for than others.
Right. Yes.
And so,
Uh,
is volatility the main metric to make it a good market to?
yes. Yes. The crazier the market, the better it is. So, for instance, can you imagine the people? I mean, I don't trade it, but the people that have been trading the Turkish Lira for the past 3 weeks have had a field day.
I had a feeling you were going to touch on that.
Field day.
On
Field day.
the interviews that we did a number of months back that are up on the website in the video section, you mentioned that specifically, the Turkish lira, and then today it's just going nuts. I was
Today
wondering.
it's been going nuts for the whole year.
Correct. Yeah, but absolutely. I mean, today, literally, at one point, it was a 25% range. I don't have the information in front of me, but I was wondering what the bid offer spread right now, or an hour and a half ago, was in dollar Turkey versus what it was, let's say, 3 months ago. I mean, it's probably untradeable, completely untradeable right now.
I don't know, but all I can tell you is that a friend of mine who does trade FX and trades those emerging currencies told me that out of the past 12 trading sessions, 9 out of the.
Hey, Mark. Mark, you
Yeah.
there?
Can you hear me?
I dropped you. You were saying 9 out of the past 12 trading sessions.
The opening in the Turkish markets has been the high low of the lira the past 9 out of 12 trading sessions.
Wow, there you go. But yeah, that's incredible. I know today actually it's been going nuts all day. Greg.
And the other thing about ACD that's important is now with 24-hour trading, right? What we do is, you typically would get long at the breakout. You'd stop yourself out at the bottom of the open range, or stop yourself out at some number which we call C, and then reverse. The problem is the reversals don't work anymore because nobody really panics anymore because of 24-hour trading. So those, the whole thing in terms of reversals is to capitalize when people are caught. Sort of like, if you and I are in a movie theater and we're sitting there and I say, Mike, there's going to be a fire that's going to break out here in the movie theater and there's one door, but you have 3 hours to get out, you're not going to panic. On the other hand, if you say, Mike, there's 30 seconds and everyone's going to get out through the door, everyone's going to panic. The problem is with the market now, with the reversals that it's having, because of overnight trading, there's too many ways to get out. So the reversals only work really when you're going into a weekend, when people, would have to keep their position and not be able to get out, or into a long holiday, because just reversals that happen, now don't really follow through that much because of 24-hour trading. That's another big thing.
Well,
People don't.
I was just going to say, touching on that topic, do you think for the broader markets, not just for ACD, but for the broader markets as a whole, that mentality has decreased volatility because people are saying, there's 24-hour liquidity. I can get out at different times, opposed to the rush of, crude used to trade for a few hours a day, things like that.
Yes, and that's why also you see typically that the markets tend to go ahead and reward people to go home long and equities over a weekend, right? Right. If you've been, I'm sure you've seen the chart where if you just went, that all the returns in the S&P in the last 7 years has been just going home long, at the close and buying it, and selling it on the open the next day. But even more dramatic than that is going home long on Fridays and selling on Monday morning, because basically because of the fact that the market, right, there's no market, until Sunday night, and there's a limited market Sunday night. People are afraid to go home this long. That's right. So there's, so obviously if you're willing to, play that, to sell the insurance and go home long Friday night and sell it Monday morning, it's been a huge winner.
Right.
Same way as if you go home short crude on Friday nights and buy on Monday morning, it's been a winner.
Oh, that's interesting. I haven't noticed that for crude. I don't follow it as closely, but equities absolutely, and you see it in the option pricing as well on the Monday options, or Friday, things like that. That there's definitely, you're rewarded heavily by just even the Sunday night when it opens and the world hasn't come to an end. The options start to melt.
Right. Exactly. And so that, and the only other thing that's interesting about that is typically most past administrations would wait till after the markets close on a Friday or something to go ahead and make any announcements. But in the current administration, they've been making announcements right in the middle of the day, which has been completely, insane for the markets. So, but that is what it is.
Absolutely. Everybody's on Twitter Trump watch 24/7, but especially during the day.
Not just him, just the whole administration. Everybody.
Sure, sure.
Right.
So, touching on that last point of ACD, you mentioned how you've refined it with different levels and different times a day. Is there any other systems that, by observing the market that you're looking at and different opportunities, especially with, I guess, AI trading and trend following, things like that, that you...
The only thing I would tell you about that, because we're in the middle of coming up with some, we're doing some stuff, is I think AI trading is going to get commoditized, because as these machines learn from each other, it becomes like a never-ending loop, and then you end up commoditizing. So the return from these machines becomes less, less, and less. And so basically, if you're a human with a brain, you can actually compete with them, because it's sort of like in the beginning, the machines were picking off the humans, and now you're going to come to a point where the humans can pick off the machines.
Right. Well, and it also seems like all the computers are doing similar sort of things. When something's working, people jump on that, cannibalize it, and then it's no longer working. But the computers are still working hard on it. So, what do you think of the markets here? It's a bit of a busy Friday. VIX has picked up. We've got equities lower.
I wouldn't be surprised if the equities sell off.
So you think going into the weekend, further sell-off, people just taking some profit?
Yeah, no, people gonna, you're gonna get paid to go home long again this weekend. That's what's gonna happen.
Yeah, it definitely seems like a lot emerging markets and global equities finally moving lower. But that said, we're barely down on the week right here for the S&P.
Right. And I said, the time there'll be plenty of time to trade from the downside, but the downside's going to come when nobody wants to sell it. Not when they make it easy for everyone to sell. Right now, the market is down 15. You can sell it all you want, right?
Sure.
So how can that work? The people that are long Apple from 120, do you think they really care that the market, that the S&P is down 15? The people that are long Waste Management from 70, the people that are long.
Hey, Mark, can you hear me? I seem to have lost Mark for 1 second. I think it'll pop back up. Hey, Mark, you there?
Yeah. Sorry, my phone's all screwed up.
Yeah, I think I know one thing I'll help you solve for the next time you're on. Yeah, it definitely seems, so I wanted to touch on one topic. When we spoke earlier in the week, you mentioned gold. Basically, you were pointing out Venezuela with offers, one of the reasons holding gold down. And, I just pointed out because...
No, it's not an offer, Mike. They're a forced seller. It's sort of like if you have, let's say you're a real estate developer and and you're going bankrupt and you have 10 properties and everybody knows you need to sell all 10, right? Are they going to give you a good price, or they're going to wait to? They're going to just wait until you have to, until they clean you out before the prices in that neighborhood rebound. They're going to clean you out. That's exactly what's happening now. Look at gold today. It was up. Now it's back.
Well, exactly. That's what I was going to point out. I mean, it's just, every reason in the world for gold to be up $50 today.
It can't. It's not, because these are all short-term metrics. Who knows? If you look back on this 4 years from now, when Venezuela's all done, everyone doesn't even remember anything about Venezuela. This price may be, substantially higher. But in terms of a short-term trading, how can you go ahead and participate in the long side, unless there's a major gap up, or B, until Venezuela is cleaned out.
Right. Any indication on, Venezuela, how much more they have to sell? From
Mike, if I knew that question, I would own the entire state of Florida. I don't know.
I thought it was worth asking.
Right.
Because, absolutely. Look, 5, 7, 10, 20 years ago, people in this environment with Turkey, doing everything and, all the geopolitical risk, you would say gold should be up $50, and it just never goes up. So it's just, you can't really buy it, like you said, until it actually starts to move.
The interesting thing that's going to happen when the world calms down, this is something that I was had a debate about with a friend of mine last night. When the world finally does calm down in terms of all this, emerging market stuff and political stuff in the United States, not if, but when, right? What's market's finally going to probably turn south when that happens?
What's that?
Stock market. Because right now the U.S. stock market is viewed as the most stable asset there is in the world, right?
Right. Right. Well,
So all the money, and all the money's going there. So when people start wanting to reinvest in emerging markets, or they want to take certain currencies, or and the earnings are about as good as they can get, where's the money going to come? Where's the flow of money going to go from? It's going to go from where it's always been sitting, which is in the U.S. stock market, and out of there and into all these other things. It's going to be counterintuitive. Again, it makes no sense, but that's what's going to happen.
right. Right. Well, I think that's been the amazing thing more recently is somebody mentioned it the other day, climbing the wall of worry. That's what the markets always do, but it seems
No,
like
it's not. It's not my worry. This is where people put their money because
right.
they feel the less risk.
Right, exactly. Money's leaving everywhere else and coming into the U.S. because they're like, all right, we've got to put our cash somewhere, so it goes there. And like you just pointed out, it makes sense that potentially when things calm down, maybe they're going to put more money in commodities or other global emerging market, equity markets, things like that, and out of the U.S. potentially. So that'll be very interesting to keep an eye on.
All right. Mike, are we good for this weekend? I think my ADD just kicked in on me.
Ah,
My trading ADD.
a lot of great information. No, very good. Thanks a lot for joining us, and we'll talk to you soon, Mark.
Take care.
All right.